and we have some big news. Tons of new rules released by Freeland, or are they? Let's take a look as we deep dive into the release that came out on the Canadian Mortgage Charter. Now, if you're thinking, James, some of these seem familiar. It sounds like some of these new rules are actually existing. Well, yeah, basically there's a retelling of an existing story, but trying to claim that it's new is essentially what's happening here. So, the media and the hype around this is that there's all these new changes. There is one slightly new one. However, this hype is just, quite frankly, as we call it in economics and mortgage terms, a load of horseshit. So let's get deeper, as we want to make sure we're making informed and educated decisions on this, and realizing what we're staring at is maybe not that new, just an old story being said a little bit louder. So let's make my giant, massive head a little bit smaller. So this is a great link that we're seeing on CBC's, trying to address that the rates have gone up quickly and that a lot of mortgages are coming up for renewal. So this is the impetus towards trying to, make some changes. Is a Canadian charter law. You can read through this fundamentals on here, but what the real meat and potatoes would be is allowing temporary extensions on amortizations for mortgage holders. What does that mean? If you took a variable rate mortgage maybe a few years ago, especially with the lenders like RBC, BMO, and TD, where they are a static mortgage payment, meaning your mortgage payment doesn't change as prime changes. And we know for the last couple of years, prime has gone up 5%. If your payment doesn't go up, then the amortization has to go up. A lot of these mortgage holders started at a 30-year amortization, as I mentioned in prior videos, are now at 80, 90, even 100-year amortizations. And the government has just said, we will allow for these extensions. You mean the extensions that have already been happening for the last 2 years, you're going to continue to allow those? Oh, thank God. There was talk of potentially forcing clients that are at extended amortizations to have to bring them down to a 30-year. You cannot buy a home with a 100-year amortization. So the question was, how are we allowing people to? Well, the credulous amount of increases caused that. So all they're saying is you will be able to continue and we'd be allowed to maintain that. They're not going to force a re-amortizing period, which would have sent payments skyrocketing, basically. And so thank God they didn't do that. Waive fees or costs that have otherwise been charged for mortgage relief measures. So, just if you have to get mortgage assistance or, what we had through COVID, basically, they're not going to charge any fees on that. This is somewhat new, exemption for insured mortgage holders. So if you had purchased a home originally and it was under $1 million and you put less than 20% down, you would have had CMHC, Genworth, or Sage, and is now called, or Canada Guarantee, as default mortgage insurance. So if you bought your home under those conditions and you paid CMHC mortgage insurance, is what we generally call it. Most people know that acronym. And your mortgage is up for renewal, then you do not have to qualify at the stress test at renewal to be able to switch between lenders. What the government is saying is, we don't want clients that can't, qualify to switch to another lender to then be handcuffed and stuck with their existing lender if they don't offer a good rate. There's no reason that existing lenders wouldn't have pulled updated credit bureaus. They technically and legally have the right, if they're your mortgage holder, to update your credit bureau. If they see or saw that your credit bureau was, maxed out, you owed a lot of debts, would they have potentially offered you a worse rate since you were stuck with them? Not, I can't say if they would have or would not, but banks do like profits, and I'm sure that was a concern. So good news, that is a bit of a change. You are allowed. So if you have not refinanced since you made that purchase, if you have refinanced, that nullifies that insurance that you originally had. Require each bank for homeowners to reach out 4 to 6 months in advance of mortgage renewal. Good news is if you're with low-income mortgages, we actually reach out every year. Again, it's 6 months out, 4 months out, and then we really stay on you. Big surprise, the banks are now being told that they should be doing this as well. Big surprise, banks do this already. Yeah, weird. They're in business of keeping the business that they have. So big surprise. So all they're doing is requiring the banks to do the things that they're already doing. Really helpful right there. Allow borrowers to make lump sums. Oh my gosh, what a crazy theory. Oh, wait, sorry. Every single mortgage in Canada right now has that freaking allowance. So again, here's an old story just being said. Most lenders, the lowest prepayment option, I believe, is at Royal Bank is 10% allowance, and this is of your original principal owing. Some of the higher lenders, MCAP, First National, et cetera, at 15%. A lot of them will allow 15% plus a double up. Scotia is one of the similar ones. Other lenders will allow up to 20%. Sorry, MCAP is 20%. So, you've been allowed to do these prepayments, payment increases. This has been around since the day mortgages were spelt with 2 G's, which has been forever. Waive interest on interest when mortgage relief measures result in mortgage payments that fail to cover interest payments on loans. So what they're saying is if you hit your trigger point and now your payment that you're making is no longer having any principal, and it's no longer even paying the interest owed, and there's excess interest, that interest can get added to your principal, but they can't charge you interest on the interest that you're unable to pay. Isn't that interesting? So if you've already hit your trigger point, you would have been called by your bank by now. No big surprise there. That the last increase has been months ago now. This should not be any news to anyone in that regard. We've had 2 pauses on prime, and we now have inflation going. The most recent numbers from 3.8 down to 3.1. We have the announcement going on December the 6th. There is no expectation that they're going to be changing that. So not a big surprise or shock here. But that's the story. Basically, the old story just being said again. So if you're shocked to find out that none of these are shocking, well, welcome to the party. This is James Lowen for Lowen Group's Money Mortgage Minute with update on all these crazy existing information we already had.